Okay, let's start with the last panel of today. Good afternoon. I'm very happy that you're all here still. Very great. And I think it's worth it because we're talking about the most hyped topic maybe right now. For me, it is the most important topic right now about stablecoins, or more Stablecoins 2.0, the new backbone of digital finance. That's the question today. And yeah, stablecoins are no longer a niche product. They're no longer just a tool for trading. They are increasingly seen as the potential backbone for payments, for cross-border settlements, and for tokenized capital markets. And before we dive in, I would like to ask each of our panelists here to introduce themselves briefly. So maybe Kai, we start with you.
Yes, thank you very much. My name is Kai Tänzler. I work at the Deutsche Bundesbank and in the department that's responsible for the digital euro, so no stable coin, but sovereign money, the digital euro. And I'm glad to be here on this panel today to talk about central bank digital currencies, or CBDC.
Okay, my name is Henri. I'm one of Quantoz co-founders. Quantoz is quite an old blockchain company. We were founded in 2014, and since 2016 we've been building I would say a token lifecycle management platform, which is now used also for issuing stablecoins. We decided, because we did a lot of projects with companies that wanted to challenge stablecoin transactions, or we decided to apply for an e-money license in, I think it was around COVID time, not the best time to start a new company within the Quantoz holding. And we got the e-money license from the Dutch central bank in 2023. And we are currently issuing 3 different tokens, euro and dollar backed. And maybe it's worthwhile mentioning that in Quantoz payments, companies like Tether, Kraken, Bybit, and Fabric Ventures invested.
Hi, hello everyone. My name is Walter Hernandez. So I am a research fellow at Exponential Science Foundation, which is a foundation that does multidisciplinary research. And one of our main areas is, of course, cryptocurrencies, particularly in my case is stablecoins. And I'm also a researcher at University College London Centre for Blockchain Technologies. And one of my main areas of recent research was about the effect that the fall of Silicon Valley Bank had on USDC and also with other stablecoins such as Tether. So where we look into the effects from the regulatory side and from the liquidity in DeFi. So that will be particularly relevant for this panel.
Yeah, Alex Höptner, I had already the pleasure to talk this morning very quickly with a new kid on the block, issuing a euro stablecoin under BaFin regulation. We applied for the license in September last year, got the license approval in July this year, and I'm live and kicking since July. We just issue a euro stablecoin under MiCA, and there's much more upcoming.
Thank you very much. And my first question would be, do we actually need a euro stablecoin? Because we have SEPA, it's near instant within the European Union, within the Eurozone, the need for a euro stablecoin.
Yeah, obviously there is a need. I think if you try to get stablecoin payments at retail shops like Aldi or Lidl, there is no need for a stablecoin there. But if you want to trade assets that are on-chain, you want to use a payment method that's also on-chain. And this is where stable coins fill a gap that cannot be filled with a credit card payment or a Wero payment or a PayPal payment. You need stable coins on-chain.
And the main use cases are like cross-border settlements, so outside the SEPA room, and then of course asset management for like switching into tokenized capital markets. That's like the 2 major use cases we have all.
Well, if you look to today, I think that more than 95% of all transactions are related to crypto trading. Yeah? But there is a big market beyond crypto trading. And today everyone says, well, there is a dollar, there's only a dollar market for stablecoins, which I don't think it's true. It's currently because the crypto trading is a dollar denominated market. You're not going to trade oil with euro. It's also a dollar denominated market. But there are other markets that are euro driven. And this is where there is a need for a euro-backed stablecoin.
I totally can support Henri in this view. I mean, when you look at domestic markets and purely domestic markets in the European Union, you can even question whether you need the stuff on chain, because domestic markets are highly efficient. Also trading is highly efficient, post-trade is highly efficient, payments is highly efficient. When you come to European Union, is not that efficient anymore. When it comes to tokenized assets, forget about it. Because if the cash leg is not on chain, then you don't have any efficiency. The big market is global fiat transactions cross-border, so crossing the border of the European Union to the international world, which is mostly done classic fiat way, and that's the big market. So as Henri said, the competition is not crypto trading, perps on Binance. It is the trillions and trillions of daily fiat transactions on a global basis.
I would like to add into that. Yes, definitely cross-border transactions is where there is a good use case. And just to give you an example for Stripe, just recently they bought a bridge for, I don't know the exact number of billions that they pay for them. Then you have Ripple that went to buy Rails, another provider that facilitates cross-border payments. And this comes as a response to SWIFT, which is a system that has been requiring some innovation and changes for a while. Because when you look at moving money from country A to country B through blockchain using a stablecoin, the amount of fees that you pay versus using as a provider like SWIFT, and the speed and processing, of course, the best use case and the best approach will be, in this case, the use of the stablecoin.
Talking about cross-border settlements, I mean, as a consequence, at some point, we don't need the banks, or they're using SWIFT or correspondent banking system, which is very inefficient, which sometimes you need many days. The costs are very intransparent sometimes. So is it a danger also, these kind of stablecoins for banks?
May I quickly, because we're always bashing the banks, and I love bashing the banks, don't get me wrong, but I think when you talk about inefficiency in systems and also in trading systems, please don't forget that before blockchain, and I'm not talking about Bitcoin trading, I'm talking about the white paper, the original white paper. Before that, double spending could not have been prevented. Yeah, and if you let that settle in, all of us would not have come up with a different financial system than the one that we have. And blockchain changed that. Now we can solve double spending. And that means all the security measures that are inefficient, now that we know that blockchain works, yeah, can solve. But that was not possible before. So when we bash all the stuff, we probably would have all come to the same conclusion and would have built the same system. Yes and no, because classical real economy doesn't want to change their banking relations just to use stablecoins. So in an ideal world, a user of these new technologies wants to have the benefits, but not the burden. Means I don't want to open up new bank accounts. I don't want to host my wallet. Come on, I'm a company. I don't want to host my wallet. I don't have blockchain developers. I don't know. I don't want to have that risk and stuff like, here's the bank, take that risk, give me the efficiency, be done with that. So if the banks are smart, they just take this. That means they erode their profits, yes, but they keep and stay in the market, they stay with the client, and they can add further services to that one. So not necessarily, but if they don't move, absolutely.
I would like to understand how we should evaluate the different stablecoins. But at some point we have, I mean, already now we have hundreds of stablecoins, even there are 2 big stablecoins right now. So what are the standards here? We don't have standards, so how should it work?
I would like to tackle this one. So in a recent paper that we were looking into the effects of transparency between 2 stablecoins, in this case USDC and Tether, If you want to evaluate both of them from studying transparency defined as how detailed is the reporting and how frequent is the information available, you would see a clear difference between both of them. So if you want to evaluate both of them. And then if you put in top of that another category such as regulatory compliance, you would see that between both of them, you have USDC that is SEC regulated in the US, and it's also MiCA compliant here. And then you have the other one, which is, in this case, taking a different approach.
Well, I think there is a kind of standard, and that's MiCAR for Europe. Yeah, so stable coins that qualify as designed to be MiCAR compliant need to fulfill the same requirements set out in the MiCA regulation. Yeah, so you could call that a kind of standard. The way they implemented it might be different, yeah, but all tokens that are issued in Europe under MiCAR need to comply with the MiCA regulation.
I think ultimately you won't see hundreds. There are already dozens of US dollar stablecoins. Guess what? Nobody cares. Essentially, there's two. So far, the euro market is small. Therefore, we have more. But ultimately, you will have, I'd say, 2, max 3. You don't want to have 1. Yeah, and in an intermediate time, there might even be special ones for special purposes. But ultimately, come from the customer's perspective. You don't want to care with several ones and maybe having to evaluate whether there's a difference or not. Okay, there will be ratings at some point in time, but nevertheless, you just want to pay. Come on, take this away. Whether it's 1 or 2 or 3, I don't care. I just want to pay. So I think it's the hot topic. Everybody wants to get into a stablecoin market. I get it. But over time, firstly, I mean, Henry, we know it is super expensive to get into that market, stay in that market, be active in that market. So some will die out of that one. And the rest, it's very hard to get, let's say, the mass adoption. So I think a few will just go away.
But does it make a difference if, let's say, I'm a CFO of a big company, if I choose a private stablecoin from a venture capital financed company, or I choose a stablecoin from a bank, a regulated bank within the European Union, for example? Is this a criteria that will make the difference that some stablecoins are, let's say, allowed to be used as for a big company, CFO? Is it like the blacklist maybe at some point for some stablecoins?
Well, maybe I can answer that question. Before we discussed about taxes, I spent the summer holidays on an even more boring topic, and that's how do you report stablecoin? And this is actually something that MiCAR might have solved. If you if you are a company and you have stable coins on your balance, how do you report them? What are they? Are they assets? Are they commodity? But what you would like to have is that it's being reported as a cash equivalent. And there are some rules under IFRS that basically explain when an asset can be reported as a cash equivalent. If you look at these definitions, MiCAR regulated stablecoins will likely qualify as cash equivalent. And we've seen the first examples of companies that hold our tokens that reported our tokens as a cash equivalent in their balance sheet. So this although it might be a real boring topic, but it's something you need to achieve mass adoption by big industries and also the banking industry.
Yes, I would like to into that. So in this case, for example, EuroC, the one that it's MiCA regulated, when you look at the reserves backing their value, it's 100% cash. And I guess that's their more conservative approach, given that MiCA requires you that if you issue a standard stablecoin, 30% should be backed up by cash. If your stablecoin is a bigger type of stablecoin, which Anyone can correct me. There's no detail what means a bigger stablecoin, at least in the micro regulation, as far as I remember. 60% of that should be in cash. So, and then you look at this example of EuroC, 100% of their issue stablecoin is cash. So then when you come to the reporting part, then you can say it could be taken as pretty much cash in your cash balance.
Yeah, but the point is, yes, theoretically yes, but it says markets in crypto assets regulation. And the problem really is, as funny as that sounds, just because the word crypto is in there, and we use the word crypto not only for stablecoins, but also for Bitcoin, the discussion is really whether stablecoins should be treated as assets which you have to collateralize at 100%, which would be ridiculous because we are 100% collateralized anyway, so we have the reserves to 100% on the reserve bank, and our customer would have to have another 100% collateralization to use the stablecoin, which would be ridiculous. And just the discussion just came because the word crypto is in, yeah, which is ridiculous. But 100% with you, it's cash, so it should be treated as cash and cash equivalents.
I'll add into that. So when you look then, the equivalent in the US with the Genius Act, which recently passed, it was all over the news, and used that as a comparison with MiCA. So the way that the Genius Act defines for the handling of the assets back in the value of the stablecoin, they give you more options. So you can use treasury bills, short-term treasury bills, US of course. They're defined as like 90 days maximum, or I don't remember the exact number, but it's around 90. And you can also have, for example, deposit at the Fed Reserve, which that means if you are, in this case, an issuer of a stablecoin, that gives you extra incentives to consider the US for doing that because you can have more options of other assets that would generate your interest for issuing there. While when you compare it with MiCA, you are more restricted. You need to have more cash backing up the value of that stablecoin, which in this example is when you see EuroC from Circle, it's 100% cash. So I think they might not be generating fees or interest in the normal way that they do it with USDC in the US.
Now I would like to include other forms of digital money in our discussion and would like to know which role do tokenized deposits play as an alternative to stablecoins?
Well, we've looked into this and we've worked on on two implementations. But it's if you don't do a proper setup, it's very, very difficult, and you need all kind of clearing houses and netting and mapping. But I also see another challenge there. So suppose you have two banks issuing tokenized deposits. And one bank is a AAA bank, and the other one is a C++ bank. Yeah. So is there a one-to-one par between these two tokens? It's not. So it's if different banks are going to issue different tokens, yeah, that are supposed to be tokenized deposits, I think it will fail by design. But it's, yeah. So what you need to do is you need to issue one common token, and that would mean that you get a stable coin that is backed by tokenized deposits, and that is a long way to go.
100% agree. I think there's a reason today that there is deposit money, yeah, and the reason by definition not goes away by tokenizing it. But it's very limited, and the interoperability with other banks is super complex. So like bank-issued stablecoins, they might have a reason, and there might be use case for that one, but they're within the ecosystem of that bank for these clients predominantly only, at least for a long time until you have solved exactly, Henri, as you said, that problem. And that means ultimately that my take is going to fail both. Because that means that customers might be efficient exploiting the possibilities of that within that ecosystem, but the ecosystem stops at the borders of that bank. If they have transactions with other banks, it won't help. They can't use it. Ultimately, they have a bunch of different tokens in their wallet which they can't evaluate against each other. They need an OTC desk to work with that. It's not going to happen.
Kai, you represent a different form of money. We talked about stablecoins, we talked about tokenized deposits, and now, of course, I would also like to talk about CBDCs. And please just start and explain, why do you think we need a digital euro from the European Central Bank? What's the intention behind?
Yes, we have now talked a lot about stable coins and their use cases, for example, cross-border use cases or B2B use cases. Where we really see the digital euro is for retail payments within the euro area. And there we see a sovereign mandate to provide central bank money. If you look at the situation today, so far, the only European retail payment instrument that we can use everywhere in the euro area is cash. But we all know that cash is used less and less. Payments are being digitalized. Everybody wants to pay digital. And of course, we also have debit cards and credit cards, and we have PayPal, with which we can pay everywhere in the euro area, but that's not European solutions. So what is lacking? The European solution for retail digital payment that works everywhere in the euro area. So currently, we rely very heavily of foreign providers. About 2/3 of digital payments are processed through non-European providers like Visa, MasterCard, or PayPal. And although digital payments are increasing, we have noticed that people still value the characteristics of cash, like privacy and simplicity. So now, with the digital euro, we are creating a digital twin of cash as a truly European means of payment. So those who want to continue paying with cash can do so, but in addition, the euro will also be available digitally. This ensures that central bank money remains available in digital form for everyday transactions on European infrastructures developed together with banks. Like cash, the digital euro would be made available through regulated financial institutions, that is via their online banking or their apps. And of course, these institutions would then be backed by the European system of central banks with a payment infrastructure for the digital euro. The digital euro would work for buying groceries, shopping online, or making payments among friends and family. So basically all 350 million citizens in the euro area could pay with a digital euro at any time. So we like to call it a true all-in-one solution.
Okay.
And then one other point, the digital euro would be significantly more crisis resilient than other digital payment methods due to the offline functionality that we are also planning for the digital euro, which would even work during short-term blackouts. So one last point maybe, we should not forget that central bank money is the foundation of trust in our system. But today it only exists in cash. And as payments go digital, we need to extend this anchor into the digital world.
Now you talked about the motivation behind a retail CBDC, but of course, there's also the alternative, a wholesale CBDC. Are there any considerations for providing wholesale CBDCs for tokenized capital markets, maybe?
Yes, indeed. Actually, both initiatives are equally important to us. So our priority is to progress rapidly on both, on the digital euro and on wholesale CBDC, that's what we call it. So the digital euro will provide citizens and businesses with safe, state-backed money in everyday payment, digital payments, and wholesale CBDC, on the other hand, will allow financial institutions to settle tokenized assets, as you said, and large value transactions in secure central bank money. So together, these two initiatives ensure that the euro remains the anchor of stability in both retail and wholesale markets, while providing solutions like stablecoins by AllUnity or Quantoz, and they operate under strong regulatory framework and add this framework of digital money.
And now I would like to know the opinion of the other panelists about that. Is it like about more coexistence between stablecoins, tokenized deposits, and central bank digital currencies, or is it more like competition? What do you think? Do we need all three forms of money, or do you think we don't need a retail CBDC or a wholesale CBDC, for example?
I would like to jump into this one. I think we should let the market to decide, see what they trust the most. And you can see this approach. Of course, the European Union is taking this approach. Then you have the US who, in their case, in the regulation, they completely ban CBDCs and are going fully private with their Genius Act. So which one would the market prefer? I would say at the end of the day is when you use a stablecoin is how much you trust the issuer to a degree. So probably they might end up trusting more the European Union. If there are European users, they will trust more European Central Bank with their digital euro. But there might be other reasons why they might prefer to go with a privately issued stablecoin. Now, the advantage of going with a digital euro, taking the other side, is bringing back to the European debt crisis in the 2008 to 2012. The euro was in a very difficult situation that kind of got solved when there's this famous speech from Mario Draghi. It's called no question asked type of speech, where he sent this powerful signal to the market that stabilized the euro. You might not be able to get something like that when you have a privately issued stablecoin. Just to put and to look into the other side, what's the benefit? Now, looking at the commercial side, we know how how government institutions might be a bit slow in moving to innovate in certain areas. So if you have a privately issued stablecoin, of course, it's still meeting the corresponding regulation in the countries that they operate, they might be able to innovate a bit more. They might be able, for example, to go into different type of public blockchains, public ledgers quickly than a digital euro will be able to. Because a digital euro, we don't know, or in this case, Kai might be able to expand in that regard. We don't know if, or at least in my case, I don't know, how will it be issued? Will it be issued in a public ledger, or will it be issued in a ledger fully owned and controlled by the European Central Bank?
Maybe I can add a few words. As far as I know, there are 3 initiatives for the wholesale CBDC: the Italian, the French, and the German ones. So that are 3 different infrastructure, and I think the first step would be to unite on infrastructure. And if I hear these discussions about some central banks say, well, we need, or we expect a maximum of 100 participants in the wholesale CBDCs, and others say we expect a couple of thousands. So you first need to agree upon the minimum. Which technology are we going to use, and who are the participants for the wholesale CBDC? Now, start the same discussion for 350 million consumers in Europe. And I think what I've heard so far about the retail CBDC is that it's not going to be programmable. Well, if you ask people and also businesses, for example, there is this famous interview of Siemens that the CFO got asked, why do you use the JP Morgan coin? And he answered with one word: it's programmable. So the market needs a programmable stablecoin, or euro, or dollar, and the CBDC is not going to offer that functionality. So there, let's say there, in a startup you would say there's no product fit.
Well, I would say there are different use cases, and so there are different products for different use cases. So we offer a product for, as I said, retail business, for buying your groceries, for transferring money to friends and family, to buying things online. You don't need programmability for these kinds of things. And those issues, those transactions where you do need programmability, you can indeed use then stable coins. You could at least use tokenized deposits if they exist. So they do coexist, and we know that the private market, of course, can innovate much faster than we can as central banks. So we don't want to compete with these innovative ideas, but we just want to provide an anchor of stability for the system, central bank money for the system, so that it can be used, but you don't have to use it. So that's basically, but it's there and hopefully provides stability. And you also mentioned our wholesale initiative. Indeed, we tested 3 different solutions, as you said, one from the Bundesbank, one from Banca Italia, and one from Banque de France. And we have now decided what the Eurosystem solution will look like. The Eurosystem published on 1st of July its project plan, so we will have 2 tracks. And under the Quantoz track, which is the short-term track, we plan to offer one Eurosystem solution, one harmonized solution at the end of the 3rd quarter of next year.
Okay, now I would like to come back to stablecoins again. And the Euro stablecoin market is quite small right now. The market share is less than a percentage. 99% is US dollar based. And Alex, you're developing a Euro stablecoin, or you have already a Euro stablecoin. So I would like to know, what does it take to make a Euro stablecoin competitive on a global scale?
And the question is, which market do you want to tap into? If you want to go for the crypto trading market, so where are stablecoins used for as margin or collateral for derivatives or perps and options, there you would have to compete on, Henry said it before, the market is on US dollar basis because it's mainly happening in Asia. There is actually a pretty healthy European flow, 20 to 30%, depending on which exchange. So there is actually a Euro demand, and a Euro MiCA stablecoin has the benefit of the anti-depegging, which is in the law, as well as of the 100% reserve. And when you look into Tether, you have the guarantee on a portion of the P&L and not the guarantee of one-to-one get your Euro back. So there might be even in interest for institutional traders to use a Euro stablecoin and eat the FX risk, because you can't eat the default risk of Tether. Now, if that is your market, well, you perfectly know how to run into the market. You have to incentivize the market makers, you have to pay the listing fees, you need to get into interesting products, and you need to be everywhere available. Now, if you go for payments, then your competition is not BTC, USDT, perp on Binance. Your competition is classical fiat payments. And the portion which is currently done by classical fiat transactions, by e-money transactions on a global basis. And there you need to be available where your customer has the easiest route to usage, which means, once again, you have to be with a bank the companies are using, you have to be in the treasury management system the companies are using, because the treasury head is probably the most conservative person, and they won't change their systems just to get the efficiency. Yeah. But on the other hand, there's no loser. As I said before this morning, in banks, there's already one winning, one losing. On trading houses, trading wins, post-trade loses, because you don't need post-trade anymore. On the treasury head, everybody wins. They get the money earlier, you have less risk, exchange risks are lower, default risks are lower, counterparty risks are lower, you get the money earlier. Okay, interest rate, how do you invest then is open topic still. But it really comes down to, where do you want to be? Yeah, and I think our big dream is into the payment space, and there the route is not necessarily over the big derivatives exchanges in Asia.
Since we are already a little bit late regarding the time, I would do a little closing round, final question, and therefore I would like to know, what's your outlook for the next 5 years? Let's say, how will these forms of money will develop? What's your expectations, your vision maybe? Maybe we pay in 5 years always Euro stablecoins at the supermarket or not, or will it be tokenized deposits, retail CBDC? What is your expectation for the future, let's say next 5 years more or less?
Yes. Well, actually, I don't know if one form of money will dominate in 5 years. What I would hope for is that in 5 years we have an ecosystem with different forms of money, with CBDCs as the anchor, as mentioned before, and private digital money as the innovators. So that together we can strengthen the resilience and the competitiveness of our financial system. So that would be my hope and my vision for the future.
Okay. So again, I don't think we're going to replace the payments in retail shops with stablecoins, but we see more and more business going to ledgers. Yeah? And if you want to facilitate the atomic swaps or the delivery versus payments, you need money on chain. And what we see already today is that some markets move away from the US dollar. Because if you work with dollars, you have a risk in Washington today. And you know, every basis point counts. So we see now trades to South America, to Africa, and to Asia increasingly happening with euros. And I think these flows, you have three alternatives there. You can use SWIFT, you can use the Visa MasterCard, or you can use the stablecoin rails. And I expect that the stablecoin rails will outperform the other two.
I definitely agree. Stablecoins, I think they'll have a big future, especially for cross-border payments. We already see it now in the short term. If you see all the news and all the things happening, the acquisitions by big players. And another example, Circle listing in the US stock exchange. Definitely, there is big potential for the use case. That's from the payment side, but I think probably it might end up happening as the adoption of Web3 technologies are being pushed, that stablecoins might end up happening behind the scenes, and the users might not know that this is happening. Probably banks will use it as a way to settle transactions between them or other providers. So I think that's probably what might end up going. Now we're talking about this stablecoin, that stablecoin, but I think probably might not even be a stablecoin, probably some digital euro or things like that happening as a way for wholesale type of settlement transactions.
I hope that the religious view of one version of the currency to the other one stops. There's a use case for CBDCs, for deposit token, for commercial bank token, and for stablecoins, and they should just coexist. I hope and strongly believe that we should have at some point in time, maybe not already next year, but the years coming, a digital euro that we use on a day-to-day basis. We need to get out of the physical cash. Yeah, absolutely sure of that. Stablecoins will tremendously change how we interact on a global basis. My expectation is this will mainly start mid to end next year, and it will also revolutionize FX markets, because as a European player, you won't have to care for other currencies anymore. You just interact with euro, and the issuer makes sure that the respective currency arrives at the place where you want to have it.
Perfect. I learned a lot. Thanks a lot for your insights. And yeah, please give our panelists a big round of applause.